Now let's have a look on question number 43. Quite easy. A couple of things are new in this and that's it. So let's have a look. CEO of a company thinks that the shareholder always look for EPS. Therefore, he considers maximization of EPS as his company's objective. His company's current net profits are 80 lakhs and the PE ratio is 10.5. Okay. He wants to buy another firm. So let's say there are two firms, X and Y. We will write it here. Question number 43. X and Y. What are the details? The details are net profit, PE ratio, 80 and 15.75 lakhs. So profit after tax, PE ratio, 80, 15.75. PE ratio is 10.5 and 10. What else? What is the maximum exchange ratio which the CEO should offer so that he could keep EPS at the current level? See, if we want to keep the EPS at current level, the exchange ratio basis should also be EPS. Okay. Given that the current market price of the acquirer and the target is 42 and 105. Now, can we calculate the EPS now? Yes, sir. Market price divided by PE ratio. 42 divided by 10.5 is 4 and 105 divided by 10 is 10.5. So this is target company which we wants to acquire and this is acquirer company, right? We have the EPS also, we have the profit after tax. We can calculate the number of share, 80 by 4. The number of share will be 20 in this case and 15.75 divided by 10.5. The number of share is 1.5 lakhs. So we have all the data. Now the very first question, maximum exchange ratio will be on the basis of EPS because we want to keep the current EPS as constant. So it will be target. EPS is a positive factor, higher the better. Target divided by acquirer is 10.5 divided by 4. That's 2.625 shares of acquirer for 1 share of target. That's the exchange ratio. Now, what is the second question? That was easy. You have solved such type of question in the very beginning of the chapter itself, where you kept the EPS constant and that's why the maximum exchange ratio has to be on the basis of EPS. If the CEO borrows funds at 15% and buys out target company in cash, not in shares. It was the shares exchange here. Now we are buying the entire company in cash. How much should he offer to maintain his EPS? Assume the tax rate as 30%. So try to understand. We want to maintain our current EPS of 4. The number of share will be 20. Number of share is not going to increase because we are offering them cash. Okay. So EPS has to be 4, number of share will be 20, right? So profit after tax will be 80, that's for sure. Okay. So how much we can distribute? We can bear a after tax interest cost of 15.75 lakh. Now I will show you. Let's say for example, let's take the offer price, offer value to be X. Let's say that whatever we want to pay to them will be X and this X will be borrowed first at the given percentage, which is 15%. We are going to borrow this much of the funds to make the payment to them. So it will be borrowed at 15%. Therefore, interest on this borrowing will be 0.15 into x. Okay, sir. Profit, we can take the profit after tax or interest after tax directly, is 0.15x in bracket 1 minus 0.30, because this interest will be deducted as an expense and we can save upon the taxes. So this is the interest after tax, 0.15 into 0.70, that's 0.105x. So therefore new EPS has to be 4, which is equal to profit after taxes of combined firms divided by number of shares. So 4 is equal to, what will be the profit after tax of the combined firm? I will show you. The profit of both the companies 80 and 15.75, 80 plus 15.75 less the interest that we are going to pay. Obviously this time the interest will reduce the profit, and that is after tax. See, this is after tax profit, so the interest I have taken also is after tax. What you can do instead is you can take the profit after tax as before tax, deduct the interest and then make it after tax. Again the value will be same. So 80 plus 15.75 is 95.75 divided by the number of share, which is 20. It will look like 80 is equal to 95.75 minus 0.105 x, and that x is equal to 15.75 divided by 0.105. It comes to 150 lakhs. We can pay maximum of 150 lakhs to buy this company. 150 lakhs to buy this company. Now I will show you the calculation. See, what is your profit before tax? Combined firm, 80 plus 15.75 divided by 70%. It comes to 136.7857. Now you will deduct the interest. If you pay 150 lakhs, interest of 15% on that, 150 into 15% comes to 22.50. This is profit before interest and tax. This is profit before tax. Now that comes to 114.2857. Now you will deduct the tax, and the profit after tax at 70% will be 80 lakhs. Number of share 20, EPS 4. Do you get that? See, we calculated the profit before interest and tax as the profit after tax divided by the after tax rate. Interest, deducted the interest out of it. So only 150 lakh is the amount that we can pay to buy that company. Then we will come to an EPS of 4. That is the maximum amount that we can offer them, that we are ready to buy your company at 150 lakhs. If you can give us, then it's okay, because our objective in buying the company is to keep the EPS after merger also equal. So that's 150 lakh that you can calculate. See, 80 plus 15.75 lakhs, and then this is 70% of the interest of this loan. This X is nothing but the loan amount that you will take. That's it. That will give you 150 lakhs. Okay, sir. This is another question. You will take this as homework. Easy one. Similar to the previous, this is again the same. Question number 44 and 45 are exactly same. You can skip one question, in fact, one of the two questions. Question number 46. Now this is what we are going to consider. I don't think so. It will be on the basis of market price. Okay, I think this is what we can discuss. Let's have a look. Question number 46. X Limited is interested in acquiring PB Limited. X has 50 lakh shares. So this is a paragraph given to us. We will convert that data into table. Question 46. X Limited and this is PB Limited. Okay. 50 lakh shares of rupees 10 each, presently quoted at 25. Numbers, market price. On the other hand, PB has 20 lakh shares of 17. Okay. The EPS is 3.2 and 2.40. Show the impact of merger on EPS in case if the exchange ratio is based on the relative proportion of EPS. Please understand, if the exchange ratio is based on the EPS, there is no impact on the EPS of both the companies. Zero impact, because you had made sure in the beginning itself that we are going to keep the EPS after merger as equal to the before merger values. So I will just show you. See. There is no impact before merger, after merger, before merger, after merger. No impact on the EPS. If the basis of exchange ratio itself is the EPS, then there will be no impact on the pre and post merger EPS. So the first question is solved. Second, suppose if X quote an offer of share exchange ratio of 1:1. So we are offering them one share for their own one share. Then should PB accept the offer or not? See, PB should accept the offer if they are getting a post-merger market value which is equal to the pre-merger market value. Assuming that there will be no change in the PE ratio of X Limited after the merger. Let's find out. What is the current market value of both the companies? 50 lakhs into 25, that's 1250 lakhs. And 20 lakhs into 17, that's 340 lakhs. So, tell me, PB Limited will accept the offer if they are getting post-merger market value of this much, right? Let's find out what is the post-merger market value share of PB Limited. Earning after tax. It will be EPS into number of shares, so 50 lakhs into 3.2, that's 160 lakhs. 160 lakhs and 20 lakhs into 2.4, that's 48 lakh. Then PE ratio, market price by EPS 7.8125, 7.0833. Okay, this is the data, we are ready with it. Now post merger values. See, we will take the combined earnings, then we are going to take the number of shares. What is the combined earning? 160 lakhs and 48 lakhs, right? That goes to 208 lakhs of the profit. How much is the number of share? We have offered them 1:1 ratio. So the total number of share will be 50 lakh plus 20 lakh, that's 70 lakhs. So post merger EPS will be 2.9714, and we are going to keep the pre-merger PE ratio of acquirer as same after the merger, same 7.8125. This will give you post merger market price 23.21. Okay, now try to understand. Number of shares held by PB Limited. How many number of shares are held by PB Limited in the post-merger company? That's exactly 20 lakh, because 1:1 was the exchange ratio. So for their 20 lakh shares in before merger company, they have 20 lakh shares exactly in the after merger company as well. And their value is 464.2 lakhs. Market value of PB Limited in post merger company is 464.20 lakhs. See, the market value before merger was 340 and now the market value is 464. You can easily calculate come to the answer at this point itself when you calculate the market price of 23.21. Their market price earlier was 17 and now they are getting 23.21 because of 1:1 exchange ratio. We can compare that 17 with 23. So obviously they should accept the offer. They are getting more value on every share. I will just show you the difference in terms of market value, in terms of market price. Market value post merger and pre-merger 464.20 and it was 340 lakhs. It is in lakhs, and market price right now is 23.21. It was 17.00. So understand how much is the extra market value that they are getting. 124.20 lakhs. What is the extra market price? 6.21. 6.21 per share into 20 lakhs share. That's 124.20. So exactly it is matching. So you take the decision on the basis of market price or on the basis of market value. Both will result into one single conclusion, that yes, PB Limited should accept the offer because they are getting a higher market value after the merger. $23.21 lakhs. See, gain to the shareholders of PB Limited is 124.20 lakhs. That's what we calculated. 124.20 lakhs. Okay, what else? The last part of this question. The maximum ratio likely to be acceptable to the management of X Limited. See, X Limited will ensure that their market value after the merger should remain same. That is, at least 1250 lakhs should be the market value after merger. At least 1250 lakhs should be the market value after merger. What is the after merger market price? 23.21. Okay, very easy. Let's take once again the third part. This was the second part and this was the first part, I think. So combined earnings of both the companies coming to 208 lakhs, right? So I will take it once again, 208 lakhs. P ratio will remain constant. That was 7.8125. 7.8125. This is the market value after merger. 1625. As an acquirer, we would want that our pre-merger market value pre-merger would remain same. The pre-merger market value of acquirer was 1250 lakhs. Do you get that? 1250 lakhs. So we would want our market value to remain same after merger. So gain is 375 lakhs. This is the maximum amount that we can pay to the shareholders of target company. Okay, market price will remain same. See, if we want there should not be any loss to the acquirer, then please understand this market value will remain same, number of share will remain same, and the market price will also remain same. Because if we are not losing on the number of share, right? And if we want the market value to be same, the difference in the number of share and the market value is the market price. Unless and until market price is 25 after the merger also, we won't achieve this target of 12, keeping the 1250 market value as same. We want the market value to be 1250. We have 50 lakh shares, so the market price has to be 25 after the merger. So what will happen? After the merger, the market price will be 25. So this is the amount that we can distribute to them, the maximum amount that we can pay. X will pay. Maximum the X will pay is 375 lakh at this price. So maximum number of shares to be given. How much maximum that we can give to them is 15 lakhs. So therefore, exchange ratio, we are giving them 15 lakhs for 20 lakh shares that they are holding right now. They are holding 20 lakh shares in PB Limited. We are giving them 15 lakhs in X Limited. So the ratio is 0.75:1. For every one share, we are giving them 0.75. I will just explain this question once again in a different way. See, the total market value is 1625 after merger, right? We want to keep 1250. That means we can distribute 375. So this is the maximum that we can pay to them. And now try to understand, this is the market value. The number of share of X Limited will remain same. Market value will remain same. Number of share will remain same. That means market price will also remain same. So this 375 will also be given at a same market price, 25. So how many shares? 375 divided by 25. That's 15. 15 for 20 lakh shares. That's 0.75:1. That's it. This is acquirer. This is target. Out of 1625, we are keeping 1250. We are ready to distribute 375 lakh. We are ready to pay 375 lakh. At what price? At the same market price. Because if this will change after the merger, our market value will also get changed. No? We don't want that. We want it to be same. This is already same. So it has to be same. See. We want market value to be same after merger. This is already same. That's why the market price has to be same, 25. So if some shares in this market value is of 25 rupees, don't you think the other shares will also be of the same price? All the shares will be of the same price, sir, 25 rupees. Whenever for acquirer, remember, the maximum is where the market price will remain same. In the first question also we kept the market price of 24 as it is. In this question also we are keeping the market price of 25 as it is. For the acquirer, market price after merger of the share will remain same. That's it. Okay, sir. Let's come to the conclusion of the third part. See, 1625 minus 1250, this is post-merger market value that can be distributed to PB Limited, which is 375. Since post-merger market value of PB Limited remains unchanged, thus 25 rupees of the market price per share to remain intact. So 375 divided by 25 is the number of shares that can be issued to PB Limited. How many? 15 lakh shares that can be issued to the PB Limited for 20 lakhs of the existing shares. So the ratio comes to 0.75:1. Good. Question number 47. In this question also we are going to discuss in a different manner the maximum and the minimum exchange ratio. Let me take a break of 5 minutes and I will be back with question number 47. See you, sir. So welcome back, and now have a look on this question. R Limited and S Limited operating in the same industry are not experiencing any rapid growth but providing a steady stream of earnings. Okay. R Limited R Limited's management is interested in acquisition of S Limited due to its excess plant capacity. Okay, sir. Share of S Limited is trading in the market at 3.20 rupees per. Other data relating to S Limited is as follows. Have a look. This R Limited is the acquirer, this is the target company, and the share of the target company in the market is at 3 rupees 20 paisa. The balance sheet of that target company is looking like this. The current liabilities, long-term liabilities, reserves and surplus, share capital 80 lakh shares of rupees 1.5 each, so that's 120 lakh. In total, the shareholders fund will be the total of these two. On the other side, we have current assets, other assets, property, plant and equipment. These are the particulars of R Limited, S Limited and combined entity. Profit after tax of both the firms independently and after merger. Residual net cash flows per year. This will be useful to calculate perpetuity value. This is just a profit. See, this first item is just a profit and the second one is the cash flows. Return on equity is this much on both R Limited, S Limited and combined entity. You are required to compute the following. Minimum price per share S Limited should accept from R Limited. See, how much minimum the S Limited should accept? Its market value. And what is the market value? How to calculate the market value? Take this as a cash flow divided by 13.05. You will get the perpetuity. Is there any growth? No, sir. There is no growth rate. So you understand the formula of Gordon's growth model? There is no growth in this. You can apply the simple formula of perpetuity is equal to annual cash flow divided by the cost of equity. So 5487 divided by 13.05% gives you around 420 45,977. This is the market value. This is the existing market value of S Limited and that is the minimum that they would want. Minimum price per share S Limited should accept. This is the total market value, right? How many number of shares are there? 80 lakhs. For S Limited, they have 80 lakh shares. In total, the market value is 420 lakhs divided by 80 lakhs. It gives you 5.256. Okay, let's just find out. See, value per share is 5.256. This is the market value. Okay, this is the minimum that S Limited should accept. But apart from that, we have the book value of the share as well. Book value. How to calculate the book value? Take the reserves and surplus and share capital and do the total of those. 279,95,000 plus 120,000,000. That's around 399,950,000 divided by 80 lakhs comes to 5 rupees. So the book value per share is 399,950,000. That is 399,95,000 divided by 80 lakhs. And that comes to 5 rupees per share. So practically speaking, the minimum price per share S Limited should accept is rupees 5. But according to me, if you will ask me, S Limited will accept at least 5.26. They will say that our market price is more appropriate than the book value. So this is the current value of the company and that should be the minimum that they should accept. I am not satisfied with the answer of 5 rupees, but it's okay. This is Institute's answer. You should go with it. That's what we can do at the end of the day. But according to me, 5.26 should be the price. Acha. This is the value calculated, theoretical value we can say, right? Calculated based on the residual cash flow. This is the book value that we have calculated. There is one more thing that is called as market price, which is 3.20. See, the shares of S Limited are trading at the market at 3.20. So my question now is, why not 3.20 should be the minimum price? If you have to take 5 out of these two because it is the lower price, then why not 3.20? All these prices are of, understand, all these prices are of S limited only. There is one more method of calculating the price of S limited. I will show you. This is profit after tax, right? This is annual profit after tax. You can use the earning capitalization method. This was the cash flow capitalization method, right? You can use the earnings capitalization method also and calculate the value of the each share of S limited, and that will also become one of the minimum price. So there is no single perfect answer to the first part in this question. I will just summarize. Let's say if we go by earnings capitalization method, we will capitalize 49,72,000 divided by 1.1305. It comes to 380 lakhs 99617. And when you divide it by the number of share, it goes to 4.76. Now you tell me, this is the price of the share according to earnings capitalization method. S limited has 4 prices. I will write all of them here. According to earnings capitalization method, it comes to 4.76. Cash flow method, it comes to 5.26. Book value comes to 5 and market price comes to 3.20. Now you tell me which price should be the minimum. See, minimum price to S limited is not something like the lower of all of them. No, they will ask the most appropriate out of this, and according to me, this is the most appropriate, 5.26, which represents the future cash generating capacity, 5.26. Or else if you have to go with the lower, you can go with 3.20. So I'm quite not satisfied with the 5 rupees, but that's the answer by the institute. We cannot help it. Okay, what is the second question? Maximum price per share R limited shall be willing to offer. Just a second. Maximum price per share R limited shall be willing to offer to S limited. It's very simple, sir. Calculate two things. Before merger market value of R limited, after merger market value of R limited. The difference between these two will be the amount that R limited is ready to pay to S limited, divided by 80 lakhs, because they have 80 lakh shares. So if we are asking 800 lakh rupees to be given to them at 80 lakh shares, we will get the price per share. That's what the question is asking, maximum price per share. Now, this is what the formula will be. How to calculate the before merger market value? It's the before merger cash generating capacity divided by 13.75%. So before merger market value of R limited is 65, 52, 655, 27, 27, 3. It is 655 lakh 27,273. This is the market value of R limited before merger. Let's say, what is the market value of R limited after merger? Combined entity 185,00,000,000 divided by 0.125. 185,00,000,000 divided by 0.125. That's 1480 lakhs. That comes to 1480 lakhs. Do you get that? So this is the after merger value. Deduct 655, 27, 27, 3 out of it. This is the pre-merger value. And we are ready to give them 824 lakh 72,727 rupees. The total number of shares are 80 lakhs. Divide by 80 lakhs. It comes to 10.31. This is the maximum that R Limited will be willing to offer on every share of S Limited, because only at that 10.31 the R Limited, that is the acquirer, will be at no profit no loss situation. They will ensure that their before merger market value is carried forward in the after merger market value also, and they are not losing on it. If they are not gaining, but they are not even losing by paying 10.31. Have a look. This is the value of R Limited right now. This is the combined entity. So if you will take the difference, this is too much of the task that they have did. I would suggest you to ignore everything. They have come to the same conclusion, but the approach that they have followed is a lengthy approach. You can simply, instead of putting this table, you can simply put a line of difference between these two and then divide it by 80 lakh. That's 10.31. Okay. Do you agree with this? So it should be like this. I will just write it down. 480 minus 655, 27, 27, 3. That comes to 824, 72, 72, 7 divided by 80 lakhs. 10.31. You can simplify the entire answer. Instead of writing so much of the things, just one small table with 5 rows will complete the answer of the second part. This is the maximum that we will be ready to pay. See, acquirer will always be ready to pay the maximum that he is gaining. He just need to make sure that before merger market value is carried forward in the after merger also. Now the third part, what is the floor value of per share of S Limited? The minimum value of per share of S Limited should be 3.20 according to me, because this is the minimum out of 4. Whether it shall play any role in the decision of its acquisition of R Limited? No, sir. It shall not play any role, because the minimum that in the first part the S Limited is asking is 5 rupees. Understand? I will show you. The minimum S Limited is asking is 5 rupees. The maximum R Limited is ready to pay is 10.31. So whenever the negotiation will start between the two companies, somewhere between these two prices, the negotiation will close. And the floor price of 3.20 is not coming in that range. That means this will not play any kind of a role in the final negotiation. Let's have a look. Floor value of per share of S Limited shall be 3.20, and it shall not play any role in the decision for the acquisition, as it is lower than its current book value. It's not just the book value. I will show you. The proper answer for a reason that it will not play any role is that it does not come in between the negotiation upper and lower limit. Negotiation limits. So this is the lower limit, this is the upper limit, and all the discussion between these two parties is happening in between this, that where we should settle. Even if the floor value, let's say for example, or any other value would have been 12 rupees, then also it will not play any role. If any price which is beyond this range will not play any role in the negotiation. Okay, next question is exactly like same. So that is your homework. Exactly like the previous question. See, we have MPLC, CPLC and combined entity, profit after tax, residual net cash flow, return on equity, the balance sheet of CPLC, the current market price of CPLC, and we are going to calculate minimum price and the maximum price once again. This is the third part, the floor value. So everything is same as the previous question. Just ending this part, coming over to question number 49. This was asked in January 21. Let's have a look. Okay. Question number 49 now. Mrs. Rolly Limited wants to acquire Messrs. Poly Limited. The following is the balance sheet of Poly Limited. Rolly, Poly. Both of them are acquiring. That means both of them are merging uh, into the mergers discussion. Just give me a second. I will adjust the pencil. Okay. So this is Poly Limited. Okay. See, whose balance sheet is this? Target company's balance sheet, Poly. Equity share capital of rupees 10 per share is 10 lakh. That means total number of shares are 1 lakh. 10 lakh divided by 10. Retained earnings 3 lakh. 12% debentures, creditors and other liability. Total 19 lakh 20,000. We have a cash of 20,000, debtors 50, inventory 2 lakh and the plant and machinery of 16 lakh 50,000. So this is what we are acquiring. We are Rolly Limited. Shareholders of Ply Limited. Ply, Poly, Rolly. I think it's Poly. So shareholders of Poly Limited will get 1 share of Rolly Limited at current market price of rupees 20 for every 2 shares. So understand how many shares this Poly Limited is going to get in the new company? 50,000, because 1:2 is the ratio. Okay, 50,000 into 20 is the market price. So practically speaking, for their equity shareholder, we are giving them 10 lakh rupees. So 10 lakh rupees is what the price at which we are buying this company. External liabilities are expected to be settled at a discount of 20,000. See, external liabilities will be settled at a discount of 20,000 and debtors and inventories are expected to realize 2 lakh. So just give me a second. External liability, this creditors and other liability. This is the debenture. We will take over the debenture as it is. This is also our liability. So from Rolly Limited, if you think from the enterprise value point of view, just the point of view, we are giving the equity shareholders 10 lakh rupees of shares. We will be discharging the debentures also 3 lakh. So that's 13 lakh. And the creditors and other liabilities will be settled at 3 lakh at a 20,000 rupees discount. So this will be the discount. So 13 plus 3, 16 lakh rupees is what the liability. And then on the asset side, debtor and inventories, this two will get settled at 2 lakh. Acha, sorry, not cash. The total of these two will be 2 lakh. So we are getting cash of 20,000 as it is. The debtors and inventories at 2 lakh. Okay. Poly Limited, Ploy, it's Ploy or Poly, I am just confused. Whatever it is, I will just make sure that it should be corrected. I think it's Ploy Limited because Ploy is couple of times I have seen, will run as an independent unit. This entire business that we are going to buy will be operated for another 6 years. See, you will settle everything, but plant and machinery, you are acquiring the plant and machinery for 16 lakh 50,000 and that's the only thing required to run this operation. So this independent unit will run for 6 years with that plant and machinery 16 lakh 50,000. The cash flow after tax is expected to be 4 lakh rupees per annum for the next 6 years, and assume that the disposal of that plant after 6 years will be at 1 lakh 50,000. So don't consider this 16 lakh 50,000. Instead consider the operations and the profit that you will make out of that 16 lakh 50,000, which is nothing but 4 lakh per annum for the next 6 years and 1 lakh 50,000 in disposal. Poly Limited requires a return of 14% at this rate. I think Rolly Limited should require the return at this rate. I will just confirm that once again. It should be Rolly. Advise the board of director on the financial feasibility of the proposal. It's very simple, sir. How much you are paying to buy the company and how much extra you are getting. That's it. If you will understand the process, today you are paying to the equity shareholder, debentures, creditors right? That is 10 lakh, 3 lakh and 3 lakh 16 lakh. But you are getting the cash balance of 0.20, debtors and inventories at 2 lakhs. So the net amount to you is 16 minus 0.2 and 2, that's 13.8 lakh. What else? 10, 3, 3, 16, 13, right? And with that said, 13.8 lakh is your purchase consideration right now, and you are going to operate for the next 6 years. So consider that as a cash inflow, this as a cash outflow, that as a cash inflow. Okay, let's have a look on the answer now. So we have external liabilities. I think the answer is different. Answer of a different question is being pasted here. 5 lakh, yes, Leopard Limited. See, that's a mistake from my side. I will do the correction. The entire answer is different now. I will request you to change the answer. Instead, change the values here. Make the corrections. That was January 21 new syllabus, and I think there is some mistake in typing, and the copy paste mistake is there. I will make sure that I sincerely apologize for this mistake. I will make sure that this is corrected in the next edition. So let's have a look. Issue of the shares will be at 50,000 shares at 20, that will be 10 lakh. The external liabilities will settle at 3 lakh, and the 13%, instead of 13%, it's 12% debentures, that's at 3 lakh once again. Okay, and the total will go to 16 lakhs, out of which the realization of debtor and inventories will remain same as 2 lakh, and cash and bank balance is 50,000. So 16 lakh minus cash and bank balance will be at 20,000. So 16 lakh minus 2 lakh minus 20,000. So 13 lakh 80,000 will be your purchase consideration. Forget about this, cancel this. Actually, I will tell you, before January 21, the same question was asked in November 2013 with a different companies and a different figures. What I did is, I replaced that old question with the new question of January 21. I asked my staff to do that, but by mistake, the question got replaced, but the answer didn't get replaced. So that's the mistake that is there. I will make sure that this is corrected. So this is the purchase consideration 13,80,000. Now what is happening in that 13,80,000? You have cancelled everything from here. You have settled the equity shares and retained earning by paying them cash. You will be settling the debentures also and the creditors also. So this liability side is over. On the asset side, you are done with the cash. You have removed the cash, debtors and inventories as well. Only thing that you are continuing for the next 6 years out of this balance sheet is this plant and machinery. So 16,50,000 of the plant and machinery is being used for the next 6 years. So instead of taking 16,50,000, take the cash flow after tax of the next 6 years and the terminal value of the 6th year and calculate the present value. That will be your cash inflow. Right now you are paying how much? 13,80,000. How much you are earning by paying this much? It's 4 lakh. I will just make the corrections here. Instead of 5 lakh, it will be 4 lakh for the next 6 years at a rate of 14%. Okay, and the total for 6 years will be annuity factor 0.877, 0.769, 0.675, 0.592, 3.888. So these two will be used. 14%, 0.456. See, instead of this it will be 14%, instead of this it will be 14%. Please make the corrections along with me. And instead of 2 lakh, it will be sold at 1,50,000. So instead of 3.684, it will be 3.888, and this will be 0.456. The 6th year's factor is 0.456. Instead of this, it will be 13 lakh 80,000, 13 lakh 80,000. This will be 1 lakh 50,000, 4 lakh, and I will just remove all this and write down the new figures. 15 lakh 52,000, 55,200 plus 1 lakh 50,000 into excuse me 0.450 minus 13 lakh 80,000. That's 2,42,700. Since NPV is positive, it is advantageous to acquire Poly Limited. That's it. This is how you have to make the changes. Again, I'm very sorry for the answer, the mistake in the answer. We are going to change this later on, but for now you can just write it down. If there is any change in this answer also, if I'm missing out something, I will just make sure that it is printed correctly in the corriendum that we are going to issue for all the people who have purchased the compiler 4th edition and the fast track batches as well. Okay sir, this is going to be question number 50 now. This is the old question and pretty good question. There are two companies, the acquirer company and post-merger acquirer company. The values of both are given, acquirer and post-merger acquirer. Okay, Yes Limited wants to acquire No Limited and the cash flows of Yes Limited and the merged entity. See, this is the target company, this is acquirer company, this is the pre-merger acquirer company, and the merged entity is the post-merger acquirer company, right? So both the companies are Yes Limited, pre-merger, post-merger. For the next 5 years, the cash flows are given to you. And see, understand, this is cash flows, not profit. Yes Limited, for the 5 years, this is in lakhs, and the merged entities. Okay, earnings would have witnessed 5% constant growth rate without merger. So the growth here is 5% and 6% with merger on account of economies of operation after 5 years. So here the growth rate will be 6%. The cost of capital is 15% in both the cases. Okay, so this will be the discounting rate. And the number of share outstanding in both the companies before the merger is the same. That means if it has 1 lakh shares, it will also have 1 lakh share. Yes Limited and No Limited has same number of shares in before merger company. Okay. And the companies agree to an exchange ratio of 0.5 shares of Yes for each share of No. So what happened? I will tell you. Let's say this is Yes and this is No. Both of them are having equal number of share. Let's say 1 and 1. And what happened because of the merger? We gave them 0.5 shares of Yes Limited for 1 share of No Limited. So after merger, it looks like this. Total number of share is 1.5. Out of which 1 share is held by the Yes Limited shareholders and 0.5 is held by the No Limited shareholder. This is the scenario in the merged entity. So what is the proportion of holding? It's very simple, sir. 67, or we can say 2 by 3, 1 by 3. Or you can say 67% here, 66.67% here, 33.33% here. 1 divided by 1.5 is 2 by 3. 0.5 divided by 1.5 is 1 by 3. Okay. PV factor of 15% are given, 15% is given to you. You are required to compute the value of Yes Limited before and after merger. How will you calculate? You just have to discount the future cash flows, and it includes two things. The present value of the cash flows for the first 5 years. Present value of cash flows for the first 5 years plus present value of terminal value at the end of 5th year. And how to calculate the terminal value at the end of 5th year? It's cash flow for the 6th year divided by cost of equity minus growth. How to calculate the cash flow for 6th year? It's the cash flow for 5th year in bracket 1 plus growth. Just a second. 1 plus growth. So you will take cash flow for the 5th year. It is given in this question, right? 350 and 620. You will add the growth of 5% and 6% in that. And by calculating the perpetuity, you will calculate the terminal value at the end of year 5, and terminal value at the end of year 5 will be discounted with this 4.497. And then the present value of cash flow for first 5 years. That's it. This is going to give you Yes Limited's value before merger. That means with these cash flows. After merger with these cash flows. Let's have a look. Present value. Cash flow of Yes Limited. Present value factor for the 5 year. And this is the present value. This is the merged entity. And this is the present value. So both of them are Yes Limited. This is before merger and this is after merger, but this is the cash flow for only first 5 years. Let's calculate the present value. Terminal value 5 is nothing but the growth rate. Just a second. So you will add the 5th growth rate of 5% here. In this case, you will add the growth rate of 6%. This is the merged entity. This is Yes Limited before merger. Both terminal value. So 15, 5%, 15, 6%. Cost of equity minus growth, cost of equity minus growth. This is the terminal value of both the companies, say 3675 and 7302. But this is at the end of 5th year. This is at the end of 5th year. We want to calculate the present value. We will multiply it with the present value factor of 0.497. And this is going to be your present value of that. So value of Yes Limited for the first 5 years, add the present value of terminal value, you will get the value of both before merger, after merger. Very simple. Before merger, Yes Limited's value was 2708 and after merger it's 5308. So Yes and No Limited both are included in the after merger company, 5308.47. Now, what is the question? Second part is the value of acquisition. How much value that you have added to the pre-merger value. So it's very simple, the difference between these two. 5308 is the post-merger value. This is the pre-merger value. The difference is what you have acquired. This is the value that you have acquired. Very simple. Earlier your value was 10. Now your value is 15. So 5 is what you have acquired. Okay. 2599.555. Now, what is the gain to the shareholder of Yes Limited? Very simple, sir. First of all, you need to find out what is the share of Yes Limited in the merged entity. It's in the ratio of 2:3. So, 5308.47 into 2 by 3. That comes to 3538.98. See? 1 by 1.5 or 2 by 3, one and the same thing. So this is the post-merger value. This is the pre-merger value of Yes Limited shareholder. Am I right or not? This 5308 consists of two types of shareholder, Yes Limited and No Limited, right? So question is asking us that these shareholders before merger are holding how much value in the after merger company? Only 2/3. And that 2/3 value is 3538.98. Share of Yes Limited in merged entity is this much. Before merger was this much. And then the gain to the shareholder. Very simple. The entire question was on the present value system of cash flows. That's it. Question number 51. We are going to see some CAPM also in this question. See. Two companies, Bull Limited and Bear Limited, recently have been merged. The merger initiative has been taken by Bull Limited to achieve a lower risk profile for the combined firm in spite of the fact that both the companies belong to different industries. See, both the companies are merged. So Bull Limited and Bear Limited. Both the companies have been merged, and the initiative was taken by Bull Limited. He thought that, or this company thought that, we will have a lower risk after the merger. Okay. In spite of the fact that both the companies belong to the different industries and disclose a little co-movement in their profit earning streams. So there is no much of the relation, not much of the relation in their earnings. Though there is likely to synergy benefit to the tune of 7 crore from the proposed merger. So synergy benefit will be 7 crore rupees. Now in this question, it is not clear that this 7 crore rupees is per annum or in total. But in most of the previous question, the present value of the synergy benefit was given. So that we have assumed that it is the total value. In this question, this is per annum. That's the problem in the question, that it will be very difficult for the students to understand. You note it. Further, both the companies are equity financed and other details are as below. See. This is the market capitalization of both the company. So can we say that the market capitalization of Bull is 1000, Bear is 500 crore. Plus there will be some synergy benefit. The total market cap right now is 1500 crore, but that is not going to be the only market value of the combined entity. The combined entity will have a market value of 1500 crore plus synergy benefit. And the synergy benefit will be calculated as annual cash flows or earnings, which is 700 crore divided by the cost of capital. So we are going to capitalize that. Okay. Whatever will be the cost of capital. This is the beta of both the company. Now, market return and risk-free rate of return is 13 and 8%. So can we calculate cost of equity for both? Yes, sir. What is the CAPM formula? RF plus beta in bracket RM minus RF. So 8 plus 1.5, 13 minus 8. 8 plus 0.60, 13 minus 8. 17%. 11%. This is the cost of equity for both the companies individually. Shares of merged entity have been distributed in the ratio of 2:1. Merged entity shares have been distributed in the ratio of 2:1. Market capitalization just before merger, you are required to find out. Okay. This is 2:1 ratio. Okay. This is Bull. This is Bear. The beta of this is 1.5 and this is 0.60. Can we calculate the beta of merged entity? Yes, sir. It will be called as a portfolio beta, where these ratios will act as a weights and these are the beta. So portfolio beta will be 1.5 into 2 by 3 plus 0.6 into 1 by 3. Am I right? Weight 66.67% and 33.33%. So this will be 1 plus 0.20. Am I right? And that will be 1.20. So this is the portfolio beta. Can we calculate the cost of the equity of the merged entity? Yes, sir. Risk-free rate plus portfolio beta in bracket market rate minus risk-free rate. That's 8 plus 1.2 in bracket 13 minus 8. That's 14%. So 14% is the cost of equity of the merged entity. Am I right? Acha. This 7 crore is the synergy benefit. It will be divided by the cost of equity to calculate the present value of all the synergies that we are going to receive after the merger. 7 crore is the per annum synergy, right? So what cost of equity will be taken in the denominator? Should I take 17% of Bull Limited, 11% of Bear Limited, or 14% of the merged entity? It will be 14% of the merged entity because this 7 crore is because of the merger. So 7 crore divided by 0.14 comes to 50 crore. See, 50 crore. The total market value of the company after merger will be 1550 crore. Calculate return on shares of both the companies before merger and after merger. See, before merger it is 17 and 11%, and after merger it is 14%. Am I right? This is the cost of equity. Now, calculate the impact of merger on Mr. X, who is holding 4% shares in Bull and 2% shares in Bear Limited. What happened to his market value? Very easy, sir. Bull, Bear and merged entity. Bull 1000, Bear how much? 500. Yes. And this is 1550, right? So he had 5% share in the Bull Limited and 4% and 2% share. 4% share in Bull Limited, 2% share in Bear Limited. So his market value earlier, before merger, his total market value was 40 and 10, that is 50 crore, right? Before merger, if we take the total market values of Bull and Bear Limited of Mr. X, it was 50 crore in total. 40 from Bull Limited, 10 from Bear Limited. But how much percentage now he is holding in the merged entity? Very simple, sir. 4% and 2% in Bull and Bear. So 2/3 is the ratio in which the shares of merged entity are distributed to Bull, and 1/3 is the ratio in which the shares of merged entities distributed to the Bear Limited. So we are just going to calculate the portfolio or weighted average proportion. 4% into 2/3 comes to, I will just do it here, 4 into 2/3 plus 1/3, or we can say 2 into 1/3. See, whatever he was holding in Bull Limited, it will be multiplied by this weight. Whatever he was holding in Bear Limited, it will be multiplied by this weight. It comes to 3.33%. That's 51.615. So his profit is 1.615 crore. This is the impact on the market value of Mr. X, who was holding 4% in Bull, 2% in Bear, and now is holding 3.33% in the merged entity. How did we calculate 3.33%? Obviously, these shareholders got 2/3 ratio. In the merged entity, these shareholders received 1/3 shares in the merged entity. That's it. See, using CAPM, 5 into 1.5 plus 8, that's 15.5. So this you have to correct. This is by mistake I have taken it as wrong answer. 15.5. This is 15.5. This is 11. 15.5 and 11. Then this is 14. Average of both. This is the average beta, portfolio beta we can say. And this is the after merger return, 14%. Then impact of merger on Mr. X. After merger, his percentage holding in the merged company will also be distributed in the ratio of 2:3 and 1:3. That becomes 3.33%. So value of Mr. X's holding before merger was 50 crore, 40 and 10. But after merger market value of the company, after merger market value, I don't know why they have calculated like this. Straight away they could have calculated 1550 crore. 1550, that's 1550 crore. So 51.67 becomes his market value now out of 50. So 1.67. See, what the institute has done here is they have took a long method to calculate the market value after merger. This was the per annum. They first calculated the per annum returns from Bull and Bear both. There was no need to do that. You could have clearly taken 1500 crore together. 15. instead of converting the two values into per annum, just convert the one value into total. So you could have just divided this by 0.14. This would have been 50. So this would have been 1550 crore. Simply. You can follow the method by the institute also, or else the another method is very simple. You can go by that way. I will just write it down to you for you. Just give me a second. Instead of doing all this chaos, you can have a different alternative also. You write down bull limited 1000, bear limited 500, it's already given, and present value of synergy benefits, which will be 7 divided by the post merger cost of equity, that's 50. So total is 1550. Now how much he is holding? 3.33%. Mr. X is holding 3.33%. $51.615. Then deduct 50 out of this and you will get 1.615. This is the gain to Mr. X. In a straight simple sentence you can complete it. Gain to Mr. X 1.615 or 67. That's it. This is the final answer to you. Question number 52, we are going to take a break and I will be back for discussion of the question number 52. All the questions are going to be completed like this only, sir. So there is no in between. Like you might be feeling something different in the mergers and acquisition and corporate valuation chapter because we are not stopping somewhere. We are not discussing a concept and we are not then coming back to a question. So it is different from the derivatives chapter, forex chapters or portfolio or security valuation because most of the concept that we are studying right now has been already completed. So there is no need to stop and discuss the concept. Like this question itself, we had discussed the portfolio beta in the portfolio management. We had discussed the CAPM also in the portfolio management chapter. So everything was already covered. So there was no need for anything else. Question number 52 after this break. Okay. So welcome back after this break and now we have a question number 52 with us. It's a quite easy question, like coming 3 questions are very easy. The 4th one will be little difficult and long and we are going to enjoy each of them. Have a look. Tir Limited is considering acquisition of Nishana Limited. The CFO of Tir Limited is of the opinion that Nishana Limited will be able to generate operating cash flows after deducting necessary capital expenditure of rupees 10 crore per annum for 5 years. See, this is related to operating cash flows, 10 crore per annum for 5 years. The following additional information was not considered in the above estimations. Office premises of Nishana Limited can be disposed. This was not considered. So that means we have to consider that. Both the companies Tir Limited and Nishana Limited is holding their own office and now Nishana Limited's office is not required. All the staff of Nishana Limited can be relocated to Tir Limited's office because we have a lot of space. So we can dispose that off and its staff can be replaced in the Tir Limited's office, not impacting the operating cash flows of either businesses. However, this action will generate an immediate capital gain of 20 crore. So this is inflow. Synergy gain of 2 crore per annum is expected to be accrued from the proposed acquisition. 2 crore per annum. Nishana Limited has an outstanding debentures having a market value of 15 crore. This is a liability. It will be considered as an outflow. It is also estimated that at the end of 5th year, that means 5 years, if necessary, Nishana Limited can be disposed of for an amount equal to 5 times its operating annual cash flow. 10 into 5. 10 crore was the operating cash flow. So we can dispose this company at 50 crore. So in total, we have this much of the cash flows to consider. Calculate the maximum price to be paid for Nishana Limited if cost of capital of Tir Limited is 20%. Ignore any type of taxation. See, after acquiring this company, this is what we are going to receive in terms of cash flow in from this company. So what will be the maximum that we will be ready to pay? The present value of future cash flows. 10 crore per annum for 5 years, 20 crore one time at 0th point, 2 crore as a synergy benefit per annum, 15 crore is the debentures that will be deducted at the end, 50 crore will be the dispose of sell value at the end of 5 years. So it is going to look like this. A very good presentation by the institute, which makes the question very simple. See, operating cash flows 10 crore for 5 years, gain on sale of the premises 20 crore at the 0th point, then synergy benefit 2 crore for the next 5 years, sale of the disposal of the company 50 crore. This is going to be the net cash flow. That's it. One more thing is left. We are going to deduct this debentures at the end. So this will give you the value of the entire company. This is the net cash flow, present value factor at 20%, present value. You are going to do the total of all of them. Very easy question, sir. And the total of all of them is coming to 75.984, less the market value of debenture, because that's the liability that we are going to take over. We are not going to pay 75, we will pay only 60.984. But after paying 60.984, you will get the equity shareholding. Plus you will have to discharge the debentures also. For you it's 75.984 outflow and 75.984 inflow. That's how the question will be. The maximum price to be paid for the acquisition of Nishana Limited is 60.984. Simple, it's nothing but the present value of future cash flows. Let's come to question number 53. Let's not waste the time. MS Stones has different divisions of home interior products. Recently, due to economic slowdown, the managing director of the company expressed its desire to divestiture, sell of its ceramic tile business. It has a different divisions. Out of that, one of the division is ceramic tiles. We decided to sell off this business. The relevant financial details of the business are estimated pre-tax cash flow for the next year. It is next year, so CF1, and that too pre-tax 200 crore. Book value of the liability 780 crore. In order to increase its share in the ceramic tile business, there is another company called as Tripati Tiles Limited. Tripati Tiles Limited is also in the ceramic business. MS Stone was also having different businesses, out of which one was the ceramic business. So MS Stone's ceramic business will be sold to the Tripati Tiles Limited. Showed its interest in the acquisition of this unit and offered a price of 950 crore for the same. So now Tripati Tiles Limited wants to buy this company or this business at 950 crore. The other data pertaining to the business is tax rate 30%, growth rate, applicable discount rate. Very easy, sir. Market value is equal to 200 crore. First of all, make it after tax. So I will write down 1 minus 0.3. This is already for the next year. This is very important. CF1. So do not add growth in that. Growth is already included. Divided by overall cost of capital, which is 12%, minus growth rate, which is 4%. So 200 less 30% divided by 0.08. It comes to 1750 crore. Out of that, the liabilities of 780 crore will be settled, isn't it? The book value of liabilities 780 crore. So the market value of this business comes to 970 crore. The market value of this business comes to 970 crore. And we have been offered for 950 crore. Okay, let's have a look on more information if we have. If market value of liability is 40 crore more than the book value is 780 crore, what will be the market value of liability? It's 820. So how much we should deduct? Instead of 780, we will be deducting 820 crore. So 930 becomes the theoretical market value of our ceramic tile business, for which this Tripati Tile Limited is offering us 950 crore. They are offering 20 crores more than the existing value. So 930, 950, more than the net asset value. So it should go further with the decision of divestiture. Yes, this offer should be accepted because we are getting 20 crores more than what the value of the company is. And it's very simple. 200 made after tax divided by cost of equity minus growth. See, we are not adding growth in the numerator because of this single word that it is of the next year. It is just like cash flow or the cash flow, or we can say dividend of the next year. Okay. Question number 54. See, question number 54 is more of a corporate valuation question. By mistake, we can say we have taken it here. We have seen such questions in the corporate valuation. 3 to 4 questions were there. Once we will start reading this question and solving it, you will realize that yes, it's true. Okay. Strong Limited is an all equity finance company. Conglomerate is in need to borrow 2000 crore. Till now it was all equity financed, but now it needs 2000 crore to finance the expansion of its crore current operation. See, you need to make the correction here. I think it's not crore, it should be core current operation. So it wants to expand its core business, whatever it is, and for that purpose they need 2000 crore. However, SL means this company, Strong Limited, is susceptible to raise the amount from the market. See, this company is all equity financed. Till now they have not raised any borrowings from the market. Right now they need 2000 crores to expand the business, and that's why they will try that they will have to borrow minimum of the amount. Since they have not borrowed till now from the market, they will try to avoid this borrowing, and they will try that this 2000 crore rupees of the requirement can be funded internally. And that is only possible if you sell one of your businesses to someone else. However, SL is susceptible to raise this amount from the market. The CFO has suggested for divesting, sell off one of the two non-core units. Both of the units that we are going to look are non-prime. It's not that important, so we can sell any one of them. But we have to sell only one of the two to reduce the overall borrowing from the market. See, right now you need 2000 crore. There will be two units given to you in the table. Calculate the value of both the unit. Let's say one of the unit that you decided to sell is worth 1900 crore. What would happen? You sell that business to someone else, get 1900 crore, and balance 100 crore will only be required to be borrowed from the market. So you can reduce the outside borrowing by selling off your business. Okay, the following data after internal due diligence has been placed for consideration of the board. Reported profit after tax is 147 and 140. Extraordinary gain, extraordinary losses. This was earlier added, now it will be deducted because this is extraordinary. This was earlier deducted because of the losses, now it will be added back. We are going to come to the future maintainable profit, and for that purpose we have to remove the extraordinary gains and losses. Now, expected profit from the branch of new product. It should be launch, not branch. I don't know whether it is in the question itself. Expected profit from the launch of new product. You remember such type of questions where profit after tax was given, then the extraordinary gains and losses, and then sales and some direct expenses were given for the launch of new product. Exactly, this is the same question. So we are going to add this profit. Okay, but before all this adjustment, we are going to convert this profit after tax into profit before tax, right? Because in profit before tax, these things will be adjusted. Now, P ratio is given to us. In the previous questions in the corporate valuation chapter, we have been given with the earnings capitalization rate. In this question, earnings capitalization rate is not given. But, if you remember, I don't know if you do or not, but we have discussed one concept in the security valuation chapter, which was P ratio is inversely proportional to cost of equity. And we are going to use this in this part. So if we are going to inverse the P ratio, we can get the cost of equity. So 10 inversely will give you 10%, and 1 divided by 12.5 will give you 8%. So this will be the cost of equity of both the units when you will reverse the price earning ratio. Because of this relationship, we have discussed this in security valuation chapter. You will find it there. Corporate tax rate is this much. Okay. You are required to advise the board on the following: the price at which the units can be divested. We have to find out the value of each unit. What should we do? It's very simple. We have to follow earnings capitalization method. So we have to first calculate future maintainable profit divided by the cost of equity, and you will be ready with the market value. Now future maintainable profit, convert this profit after tax into before tax, deduct this gain, add back losses, add the profit from the new product, and then deduct the taxes, once again profit after tax, and then discount it or divide it by the cost of equity. Have a look. See, this is profit after tax converted to profit before tax, reducing the gains, deducting the gains, extraordinary gains, adding back the extraordinary losses, adding profit from the new product. This is the new profit before tax, less tax, future maintainable profit after tax, right? Now, this is the P ratio, but 1 by P ratio will give you the cost of equity. This is the capitalization factor. So this future maintainable profit and the capitalization factor will give you the price of each unit, which will be 1890 crore. Fortunately, unfortunately, both the units are still priced at the same value, that is 1890 crore. You can sell off any of the unit and you will get 1890 crore. Your total requirement is 2000 crore. Once you sell any of the unit, your requirement will come down to 110. That is 110 crore only. You can get 1890 crore by selling off one of the unit. Now the second question, the unit which can be divested so as to minimize the borrowing from the market. Now you tell me, from unit 1 or 2, which unit you should divest or which unit you should sell. It's very simple, sir. Whichever unit is costing you more, should be sold in the market. Try to understand. Both the units are having same value, but the cost of capital on unit 1 is higher than the cost of capital on unit 2. What does that mean? It means that we have to give dividends, and the capital appreciation requirement in this unit is higher than the other unit. So the dividend, whenever you will distribute the dividend, it should be higher in the unit 1 because of the higher cost of capital and lower in unit 2. So which unit you will divest? The unit in which is costing you more, that is 10%. This is the cost of capital, right? Cost of capital, isn't it? So if the cost of every 1 rupee is 10% here, why would you keep this? Because both are having same. You have to pay only 8% on 1890 in this case, in keeping this business. And in keeping this business, in running this business, you have to pay 10% on 1890. Why would you do that? Sell off unit 1. So there are two answers to this. Higher cost of capital, or the inverse of it is P ratio lower. You can clearly see higher cost of capital or lower P ratio means one and the same thing. Lower P ratio also means the same thing, that it is costing us high or more to keep running this business. Low P ratio means that only. So the unit 1 can be divested as it has lower P ratio, or we can say higher cost of capital, because P ratio and cost of capital is exactly opposite. So low P ratio means high cost of capital, which is 10%. Simple. So you will sell off that business and reduce your borrowing from 2000 to 110. See, the amount of borrowing required now is only 110 crore. That's what your business is. You have been equity financed yourself, like your company, till now, and you will still try to do the same thing. And that's why you are borrowing the minimum required amount. That's 110 crore. Quite a good question now. Let's move on to the next one. Question number 55. This is going to be an interesting question, and this is the question that has been asked like this. This has been there in the syllabus since 10 years. So I don't know whether this question will be asked in the exam or not, but still it's a quite good question to consider in the mergers and acquisition chapter. Let's have a look. See, Personal Computer Division of Distress Limited. There is a company, Distress Limited. There is a division of a computer. Personal Computer Division of this company, Distress Limited. A computer hardware manufacturing company has started facing financial difficulties for the last 2 to 3 years. So this company is not doing good right now. The management of the division, which is headed by Mr. Smith, is interested in a buyout. Understand? This process is called as management buyout. What happens when you will read the theory of mergers and acquisition, you will realize that there is a concept called as management buyout, where the company, if the company is not doing good, what the management of the company does is the management still believes that by doing something or the other to this company can be brought back on the track. So what they do is, first of all, they buy the company and they become the owner of the company. On 1st April 2013, Mr. Smith decided to buy out this company. However, to make this buyout successful, there is an urgent need to attract substantial funds from the venture capitalist. It's very easy, sir. See, although the management believes in the company which is not doing well, management wants to buy out the company, but in order to buy the company, management might not have the sufficient fund in their bank accounts. So management will go to the venture capitalist, to the banks, or to the other people who can lend them money. So there is one person, Vencap, a European venture capitalist firm, has shown its interest to finance the proposed buyout of Mr. Has shown the interest to finance the proposed buyout. What does that mean? Mr. Smith and Vencap, European venture capitalist, together are going to buy this company. So Mr. Vencap will provide whatever the funds required to Mr. Smith, and Mr. Smith will buy the company. Okay. Distress Limited is interested to sell the division for 180 crore, and Mr. Smith is of the opinion that an additional amount of 85 crore shall be required to make this division viable. See, 180 crore will be the selling price. That's totally okay. But after buying the company, an additional 85 crore rupees will be required to restructure the company so that this division becomes viable and this division can sell the products in the market. It becomes profitable. So in total, the total funds are 180 plus 85, that is 265 crore required. Simple. So the expected financing pattern shall be as follows. The management will buy the equity share in the new company of rupees 10 each, worth 60 crores. Vencap will also take the equity shares worth 22.5 crore. Vencap will issue more funds in terms of 9% debentures worth 22.5 crore and balance 8% as a loan as 160 crore. In total, this 265 crore rupees will be funded in such a structure. So Vencap will have three types of instrument in the company: equity share, debentures and loan. Okay. How many shares are there with the management and Vencap? 6 crore and 2.25 crore. Am I right? The number of shares. Okay. Because shareholding, equity shares will decide the ownership pattern of both Vencap and management. Right now, total number of shares are 8.25. Where we can say that the management is holding 72.73% and 27.27% by Vencap. This is the percentage of holding. Now, the warrants can be exercised anytime after 4 years. Now, which type of warrant? Understand, this 9% debenture with attached warrant of rupees 100 each. What does that mean? It means that right now this 22.50 crore rupees is issued in terms of debenture, but this debenture comes with a warrant, a document, or we can say an option where the Vencap can convert this debenture into equity shares. Right now, how many debentures are there? 100 rupees each. So 22.50 divided by 100. I can say that 0.225 crore debentures in numbers are there. Each debenture can be converted into some equity shares after 4 years. See, the warrants can be exercised anytime after 4 years from now for 10 equity shares at rupees 120 per share. Now what will happen? Understand. 10 new shares will be issued. If you will issue 10 new shares, the total number of equity share that will be given to the VenCap will be 2.25. Am I right? 0.225 debentures. So this is the number of debenture 0.225 multiplied by 10. This will become the number of equity, which will be 2.25. Right now we have 8.25 equity shares, right? After the conversion, the total number of equity share will be 10.50. Okay, we'll talk about it later. The loan is repayable in one go at the end of 8th year. See this 8% loan. Can you see that? This 160 crore of the loan will be paid at the end of 8th year in one go. Till that time, every year 8% on 160. That is 12.8 crore interest will be paid every year. The debentures are repayable in equal annual installment. Now the debenture, coming over to this debenture. This will be repayable in equal annual installment consisting of both principal and interest amount over a period of 6 years. Now you have to prepare a repayment schedule because we have to calculate the EMIs of this debenture for 6 years. Mr. Smith is of the view that the proposed dividend shall not be kept more than 12.5% of distributable profit. Whatever is the profit after tax, 12.5% of that distributable profit, whatever is the distributable profit for the first 4 years, we are going to distribute maximum 12.5% of that as a dividend. The forecasted EBIT after the proposed buyout is as follows. For the next 4 years, we are going to earn this much of the EBIT. EBIT less interest of loan and debenture. Okay. Then EBT, then tax, EAT, and then dividend. Applicable tax rate is 35% and it is expected that it shall remain unchanged at least for the 5 to 6 years. In order to attract the venture capitalist, Mr. Smith stated that the book value of equity shall increase by 20% during the 4 year. See, all in all, this question is very long and we are going to continue with this. What happened? Mr. Smith believed in this company, and in order to finance this company, Mr. Smith went to the venture capitalist and Mr. Smith said that this company is going to grow by 20% each year. So that's what he said, that the book value of equity shall increase by 20% during the first 4 years. Although venture capitalists has shown their interest in the investment, but they are doubtful about the projections of growth in the value as per projections of Mr. Smith. They are interested in this business, but they are doubtful on this 20%. They don't know whether this company's book value of equity is really going to grow by 20% or not. Further, venture capitalists also demanded that warrants should be convertible in 18 share and not 10 shares. See, right now the condition is every debenture will be converted into 10 equity share. But what the venture capitalists are demanding is it should be converted into 18 equity shares as instead of 10. You are required to determine whether or not the book value of equity is expected to grow by 20% or not. Further, if you have been appointed by Mr. Smith as advisor, then whether you should suggest accepting the demand of 18 share instead of 10 or not. So too much of the data in the company, but only 2 things are required. Calculate whether the growth rate in 4 years of equity is 20% or not. It's very simple. Consider the equity and reserves and surplus today. Consider the equity and reserves and surplus at the end of 4 years. Find out the rate. This will be your principal. This will be your compound amount. Find out the rate of return in this 4 year. It should be more than 20%. First of all. Second thing, Mr. Smith should accept the conversion of debentures into equity shares, 1 debentures into 18 equity shares or not. See, it all depends upon the ownership pattern. If Mr. Smith agrees to 18 shares on 1 debenture, what will happen? I will just show you. This is Smith, this is Vencap. They are holding 6 crore and 2.25 crore shares right now. The total number of share is 8.25 crore. Now venture capitalist is also holding 0.225 debentures. Okay, this is number of debentures, and they are asking that for every debenture we need 18 shares. That means in total we will have to issue 4.05 crore of shares, and all of them will go to venture capitalist. So after this conversion, the shareholding pattern will be like this: 6 crore by the Mr. Smith, and 2.25 plus 4.05 crore, that is 6.25 crore by venture capitalist. In total it will be 12.25. Mr. Smith should not accept this offer, because you can clearly see Mr. Smith is losing the control of the entire company here. When venture capitalist will have more shares than Mr. Smith, the entire control will go to venture capitalist. This 0.25 of the extra shares that venture capitalist will get will take the control from Mr. Smith's hand, and Mr. Smith should not agree on this. This is the sole reason that if we agree on the 18 share per debenture, we will lose out the control of the company, and that's why it should not be accepted. That's it. This is the answer to the second part. Now let me come to the answer to the first part. You have to do it very easily. First of all, you have to prepare. The biggest task is to prepare the EMI schedule for the next 6 years at 9%. This is the principle 22.50. How to calculate the EMI? It's very simple. Present value of annuity is equal to annuity into present value annuity factor at 9% for 6 years. That's it. This is the present value of annuity, 22.50 crore. This is going to be your annual amount, and that's 2. Just a second, once again. 1, 2, 3, 4, 5, 6. So that's 4.486. 1, 2, 3, 4, 5, 6. 4.486. So annuity will be 5.0156 crore. Every year you are going to pay this much of the annual installment. This includes principal and interest both. So what are you going to do? You are going to prepare a schedule where you will take year 1 opening balance, interest, installment, and then principal, and then closing balance. Very simple, sir. Opening balance is 22.50. 22.50 into 9% comes to 2.025. The installment that you will pay is 1.0156. Try to understand. I think you have done it in the CA intermediate class, and you can do it on Excel sheet as well in your real life. So how much installment you have paid for the first year? 5.0156. How much was the interest out of that? 2.025. So the difference between these two will be the payment of interest, principal. You have paid the difference as a principal payment. So 5.0156, that comes to 2.9906. So the principal in the beginning was this. The principal that you have repaid is this. The balance of these two items will be the closing loan. That comes to 19.5094. So 19.5094. Again, you are going to calculate 9% interest on that. Installment will remain same, the difference amount principal and the closing, and you will keep doing it. See, you can keep doing it for 6 years, but we need it only for 4 years. So there will be a closing balance here. You can just finish your calculation till the end of 4 year, and you can take these figures, because we need this interest to be deducted from EBIT. Now have a look on the answers. The very first thing, 5.0156 crore. We have taken the schedule for only 4 years, and you can see there is still a closing balance which will get zeroed, which will get zeroed in 6th year, because the loan period is 6 years. Okay, repayment schedule. So this interest will be deducted from the profit and loss. Okay, now let's start with the EBIT. Now the question is very simple. EBIT, interest on 9% debentures as you calculated in this schedule. Okay, then interest on 8% loan, it will be same for all the 4 years. Okay, this is EBT, then tax, EAT, then question was very clear that you will be paying maximum of 12.5% of the distributable profit. Okay, we just need to correct this of this extra wording. 12.5% of the profit that you have earned will be distributed. This is the dividend payout ratio. This will be the balance. We can say it will be transferred to reserves and surplus. So 18.8685 was the profit left in the company for the first year. So balance brought forward from the previous year was nil, because this is the first year. Then this balance of 18.8685 will be carried forward to the reserves and surplus account in the balance sheet. So this is reserves and surplus, this is share capital. This is reserves and surplus, this is share capital, and the total of these two is the shareholders fund, shareholders equity. Now coming over to the second year, we are going to repeat the process and we will be left with the 24.14 crore of the profit of that year. Now try to understand, this is the profit of that year, this is the profit brought forward from the previous year. Okay, now the total of the reserves and surplus will be the total of this year's profit left in the company and previous year's profit carried forward. So total will be 43.0085. Now what we are doing is every year we are adding the profit in the reserves and surplus. So this 82.50 of the share capital will remain same, but you can see the reserves and surplus are increasing every year. This increase in every year is nothing but this value. Every year's retained earnings. This is called as retained earning. Earning after distribution of the dividend is called as retained earnings. It will be added to the previous year's reserves and surplus. And at the end, you will have this much of the reserves and surplus and this much of the capital, paid up share capital. So when you started your business, you started it with 82.50 crore at 0th point. This 82.50 crore was the share capital. How did we arrive at 82.50 crore? I will just show you. The share capital in the beginning was 82.50 crore and it is the total of the share capital of these two, Smith and Vencap. These two guys contributed 60 crore in the equity share and 22.50 crore. So we started the entire business with this much of the share capital. Okay, this 82.50 crore at 0th point has grown to 194.7795 in 4 years. That's what we want to calculate, that what is the rate of 82.50 crore to grow at 194.7795 crore in 4 years. Calculate the rate in between. This will be your principal, this will be your compound amount. The good part is it is for 4 years. So if you will type square root button twice, you will get the answer. See, the formula will be like this simply. Compound amount is equal to principal in bracket 1 plus r to the power t. So 194.7795 is equal to 82.50 in bracket 1 plus r to the power 4. And it will be like 194.7795. I will just take the answer. 194.7795 divided by 82.50, that's 2.360 to the power 1 by 4. You just press square root button twice and you will get the answer. That is 1.2396 is equal to 1 plus r. R will be 23.96%. So this is the annual growth rate, and which is more than 20% as committed by Mr. Smith. So yes, Vencap will get satisfied with the commitment made by Mr. Smith that in 4 years the capital will grow by 23.96%. That's it. You started with this 82.50 at time 0. I will just show you the timeline. It was at 0th time 1, 2, 3, 4. 82.50, then it became 101.3685, 125.5085, 156.0725, and in the end 194.7795. So all you had to calculate was this, that at what rate this 82.50 has become 194.7795. That's 23.96%. That's your first answer, and the second answer was already discussed by us, I think. See, 6 crore and 6.3 crore. It may likely that Mr. Smith may not accept this is his condition, as this may result in losing their majority ownership and control to Vencap. Nobody is going to accept this offer, because see, Smith, after this 18 shares offer, the offer of converting one debenture into 18 shares, if we accept this offer, Mr. Smith will be holding only 6 crore shares of the company, and Vencap will be holding 6.30 crore shares. What will happen? The entire control of the company will land in the hands of venture capital. So Mr. Smith will have no control of or any decision of the company. That's a bad thing. So Mr. Smith will not accept this. Yeah, 10 shares for one debenture is still okay for Mr. Smith. That's okay with him. That's it. Question number 55 is over. Question number 56 after a short break.